Hey everybody, hope everyone's doing wonderfully well. Welcome to the No Shill Zone with Ben Cowen. My pleasure to have him here with us. We did our show last week and we're back again to do it again. So, Ben, how you doing today, buddy?
Pretty good. How about you? Pleasure to be here again.
Yeah, absolutely. So it looks like you're on vacation, relaxing a little bit.
Yeah, we're just trying to enjoy the summer, soak up the sun, but the markets are alive at all times, so we still got to do this. So and it's a lot of fun
Absolutely,
to do it too.
absolutely. Very cool. So I know people are here and wanting the alpha and the information and the no shilling portion, which gets us into the nitty gritty of the data as well as kind of the charts. And so I would say first to you, Ben, is where do we stand? I mean, last week we came in, the SEC had just kind of smoked the altcoins. We were talking about Bitcoin dominance. From that point to this point, where are you sitting?
Yeah, so I think, and I mean, I'll show the dominance on my screen, but one of the things that I continue to reiterate with the SEC and sort of the idiosyncratic risk of the altcoin market, the regulatory risk of the altcoin market, is that they're likely going to continue bleeding against Bitcoin for likely, I'm guessing until September. And I briefly touched on this last time, but I was having some issues sharing my screen last time, so maybe I'll take a minute to just kind of show my point of view here. Is that normally September's mark changes in the Bitcoin dominance. Like whatever's going on before September, it kind of seems like we see a shift around that September timeframe. If we're going down, we start going up. If we're going up, we start going down. And so what I'm expecting is, if I were to maybe potentially draw a path here for the dominance, I'm kind of expecting the dominance to continue its breakout and actually go near that 60% level by potentially, September plus or minus 1 month or so. At that point, I kind of expect it to pull back. I mean, that'll likely be around the time that a lot of people finally put on, they put on their Bitcoin maxi hat. And normally once everyone starts to agree, then you get a more substantial pullback. But I don't think we're at that point yet. I still think that we need to see the dominance break out and go a lot higher. Now, one thing, Gareth, that we talked about a little bit is that when we break the range high on the dominance back in 2018 and when we broke it in 2019, in both cases, we actually had about a 1 week period where we didn't move, right? Where the dominance basically just stayed flat for about 1 week. And then the next week, it went up by like 3 or 4 points, like 3 or 4 percentage points. So like we went from, in 2018, we went from 50% to 54% in 1 week. And in 2019, we went from 64% to 68% in 1 week. So I'm still, I'm sitting here thinking like, within the next, maybe even this week, but within the next couple of weeks, like I wouldn't be surprised if we see a more substantial breakout on the Bitcoin dominance to 50%, 51%, 52%, and maybe even just a bit higher. What are you thinking?
Yeah, so just flipping over to my screen here, and we can talk a little bit about that. So, what's interesting is what I'm getting from you is that you're saying you think that we'll go up to about 60% in terms of dominance. And I think last week we talked about the charts and what it showed. And the beauty of it is there's this awesome trend line that is right at 60%, right? So,
Right.
am I correct? And that's what you're thinking it's headed towards?
Yeah, I think around 60% is a good year, is a good target for this year for sure.
Yeah, so I think that makes sense. The question I would have, and a lot of people are wondering, like, has Bitcoin bottomed? So for me, I'm not convinced that Bitcoin has bottomed, even if it remains higher in the dominance factor. Could it be that the altcoins are still headed much, much, much lower? Bitcoin may come down a little bit, maybe retest that 15.7 or even go lower level, but it still increases the dominance in there. And again, I was curious about your thoughts on that.
Yeah, let me show my screen here for a minute because there's a couple different ways to look at this. The first way to look at it is in every cycle, in every market, we see Bitcoin bleed for a while and then it gets a rally. And it's in that rally that we break the range high on the Bitcoin dominance. If we were to overlay the Bitcoin dominance onto just the price scale here, right? We can see that Bitcoin's rally here in 2018, half of that rally was accompanied by Bitcoin, or sorry, the half of the dominance rally was accompanied by Bitcoin going up, and then the other half of the dominance rally was accompanied by Bitcoin going down.
Mm.
And then ultimately what happened is that the market sort of leveled off for a few months, and then the actual bottom was found, right? So that's what we saw back then. And one thing that I think is interesting today is we actually saw a very similar thing, right? Bitcoin rallied for the first 4.5 months of the year. The dominance broke 49% back in April. And now I think we're in this process where the dominance is continuing to go up as Bitcoin goes down. Now, fundamentally, the reason why I think that's happening is because there's this move from like higher risk altcoins to lower risk cryptocurrencies like Bitcoin. And so for a long time, people just convert their altcoins back to the safety of Bitcoin, right? It's not to say that Bitcoin can go lower. It's just that it's safer than insert, random altcoin, right? And so those conversions can keep the valuation of Bitcoin propped up. But at some point, I think there's just no longer sufficient liquidity in the altcoin market to support valuations, these higher Bitcoin valuations, right? And so then people are converting back to Bitcoin, but there's still so much sell pressure on Bitcoin side that it just keeps coming back down. Now, I think where the issue is, well, what happens when all the liquidity is dried up, right? And if you look really closely here, there is a period here where the Bitcoin dominance rally was this July rally right here, right? And you can see that this was something I don't really know that I've even talked about this before, but from this low here to this low, it was about a 12% drop, right? And then after this 12% drop, that's where the dominance rally happened back in 2018. And if you look today, you can kind of see a similar thing, right? Like this low here to this one was also about a 12% drop. And that is where the dominance rally started, right? So there is, there's a risk that we still have to come back down. And as you said, Gareth, I mean, there's of course a risk that Bitcoin does in fact put in a new low.
Yeah. Do you foresee a portion of, like, let's say a time in the future where Bitcoin dominance goes above 60%? Like, I mean, 60% is the target based on your data, based on the charts. But I mean, let's say 5 years from now, is Bitcoin like the biggest thing, and then you just have one or two little alts that make up 10% of the market and everything else has gone to zero? Or do you think that it kind of stops around that level?
Yeah. So I think like there's actually some conflicting views here, and I'd like to get your opinion on this too. So if the chart I have on the screen right now is actually the dominance excluding stable coins, because I think that there's a dominance on TradingView which includes the stablecoin market, and you have to ask yourself, of course, well, should we be tracking the dominance excluding stable coins, right? Like where you're actually looking at the altcoin market with respect to Bitcoin. And when you look at it like this, what you'll see is that the dominance excluding stables is already at almost 55%. But it's also been putting in lower highs, right? Like one lower high after another. And I think that's what a lot of people look at. But there's another thing to look at too. It's been putting in higher lows since 2018, right? I mean, like this was, 32% or something. And I keep thinking like, despite all the VC money, despite all this, the NFT, despite all this stuff, the dominance didn't even put in a new low.
That's a good point.
So I'm thinking like, and if you kind of connect the dots here and draw them out, the lines converge in 2026 actually is when we actually see them converge. So I don't know what way it's going to break. It might actually depend on regulatory clarity. Well, what do you think?
Yeah, I think that, from my perspective is definitely Bitcoin's on that track to be that digital gold asset. And I think Ethereum is likely the silver kind of the crypto markets. And what's interesting about gold and silver, right? So gold is your pure play, where it's just a store of safety, inflation hedge, all that kind of stuff. And then Ethereum is like silver, in that silver is more volatile than gold. So Bitcoin is less volatile and Ethereum is more volatile than Bitcoin. But also Ethereum has a use case, right? Bitcoin, there's, you don't really see a lot of stuff being built on top of that. So I think my guess is, and again, I could be wrong here, but my guess is the future is those two make up probably 80% plus of the overall market. And then you might have some of these other smaller coins kind of carving out their niches, but it's hard to know. I mean, and now we have the biggest news in the last week was that BlackRock filed for a ETF, right? And so the question is, and I think the big question, we saw a little rally in crypto because of this, is does this mean because there's such a mega financial institution that they talked to Gary Gensler, and Gary Gensler might have said, hey, listen, yeah, Bitcoin isn't a security, so we're going to give you, the biggest financial institution, the green light. Because I think if you look at the stats, right, BlackRock's filed for like 75 ETFs. they've gotten approved on 74 of them, right? So they obviously have this kind of ability to kind of say, okay, if we're going to do this, the probabilities of success are very high. Yet we've seen the SEC reject time and time again a spot ETF. So it's kind of interesting here.
Well, one of the things it's funny because we've never even talked about this before. You said the Bitcoin dominant. You think Bitcoin and Ethereum collectively could make up about 80% or so.
Yeah.
If you look at my screen here, this is the Bitcoin dominance plus the Ethereum dominance, and to me, it looks like an oscillator where it's around 85%. It comes down to around 55, back to 85, back to 55, and I mean, it kind of seems like it's just in the process of going back to 85. You know. So, I mean, it's interesting because we go through these periods where, no one can ever imagine, the blue chips taking up such a majority of the market share. And then that's what ends up happening. And then once we get to that point, everyone will say that altcoins are dead and they'll never recover. And then we get alt season. It's interesting how we ebb and flow.
I don't have this sort of, I don't have this data, and it's just, what you said just jogged my memory or to think about this. But I'd love to know the dominance of gold and silver versus palladium, platinum, copper in terms of that, like if I don't know if there is a chart of kind of looking at that, and do you look at it in the same way of value versus use case? I don't know, but just interesting to kind of look at that and say, okay, well, platinum's used in batteries, we know silver is too, but I mean these other metals, I mean copper's used in wiring, it's a massively used, but it doesn't have a high value because it's not a scarce asset, right? It's only $3 per unit. So anyway, just something I was thinking about there in terms of relating it to the commodity markets.
I might actually try to get that chart for next week so we can talk about it.
That would be cool to see, man. Very cool. So what I do want to show here, and I'm going to flip over to my screen here, is I do want to go over that gold chart. A lot of people have been asking me, do you still see gold breaking out this year? We've kind of see gold languishing here. And the one thing I would just point to, and this brings us over to the stock market side of things, is that gold is stalling here. But what we're seeing is there's a massive inflow of bullishness into the market. So in general, when you see stocks like Nvidia going to new all-time highs and things, in general, you see gold falling more because it's a safety hedge, right? It's people saying, hey, I don't want to be in gold because I want to be in risk assets where I'm going to make more than a few percent on a yearly basis, which is more along the lines of what you expect from gold. And so I find it fascinating. And it's the same sort of thought process that I had when we were trading at the lows on gold in 2022 and going back to 2021 and the markets were at their highs. You weren't seeing, and by the way, this is when the Fed was raising most aggressively, and generally gold reacts very negatively to hikes in interest rates. Gold was not breaking down outside of this kind of choppiness. It got to this low end and then started to rally back. So for me, when I look at the price action in gold, gold is staying stable while you're seeing risk assets aside from crypto rallying substantially. I think the NASDAQ now is year to date up something like 38%. I mean, a massive, massive move. And so to me, this is a very bullish sign for gold. It's telling me that you have sellers that are moving out of gold to move into risk assets, but there's definitely buyers there. Thus, price is not falling. I don't know if you have any thoughts on gold, but I'd love to hear them.
Yeah, I will say, going into 2022 for people that are on my channel, I know you were saying back then, like this was back in 2021 when like everyone was bullish crypto, right? You're like, gold's going to outperform Bitcoin in 2022. And I mean, it did by a lot, right? I mean, Bitcoin dropped 77% or so during that year. So that was a great call. I think that my view on gold is kind of like where we were in 2019 is that we saw a massive pullback in crypto in 2019, and it was more so just a marginal pullback in assets like gold, right?
Yeah.
Where they pulled back to their 20-week SMA and their 21-week EMA in 2019, but that's ultimately what held out support, right? You can see we held out support in May of 2019, we held out support in late 2019. I kind of think that's what's happening here as well, is my guess. But the thing that I think back to is how gold and silver had pullbacks, but and so did the S&P, but crypto as a whole, right? If you take just like say Bitcoin only rallied for half the year, and Bitcoin fell kind of when gold fell, right? Like into this, but gold kept going, whereas Bitcoin did not, right? Like Bitcoin kept falling until April or March of 2020. So I kind of think we're in a similar phase where we likely will see gold continue to do pretty well as we continue to push forward in this business cycle.
Interesting. Now turning to the business cycle, what are we thinking in terms of, right now you're hearing soft landing, you're hearing, stocks are going to make new all-time highs. And in all fairness, I've been off sides on this. I mean, I was bearish over the last month or so, and the markets have just ripped up. So it's one of those things where are the masses, as they turn bullish and they're FOMOing into stocks, are they going to be right, or are we going to see cracks in this narrative that everything is going to be okay?
Yeah, that's a good question because I think it's probably a positioning thing. I think a lot of people are positioning for the more bearish outcome just because things fundamentally are starting to crack. And I know you were talking about this as well before, but initial claims, they've been pushing higher recently. I think they've been around 260. I mean, I think before we see the unemployment rate at like 4 or 5%, we need to see initial claims continuing to put in high prints, right? If we just go back down, then it'll likely just be nothing. But normally, you can see that initial claims lead the unemployment rate. So like the orange line on this chart is the unemployment rate, and then the orange line is the initial claims, and the blue line is the unemployment rate. And normally, the unemployment rate moves after initial claims goes up, and you can see, I mean, recently initial claims has been really starting to climb back up,
Yeah.
somewhat slowly. And there's this other thing I was looking at recently as well, and it's basically the ROI to low after a yield curve inversion. So like going back to the 1980s, this is the S&P 500 ROI to low after the 3-month inverted the 10-year. And you can see that this current cycle is definitely outperforming prior ones, like where we are. But we can also see that there are cycles that, they still held up pretty well, and then eventually they put in new lows. Now, I was sort of toying around with this and just looking at random spreads between different things that a lot of people might not care to look at. But an interesting one was the spread between the 2-year and the 5-year. And if you isolate, just say like this orange one up here, which was the one back in 2007, 2008, you can see that it was also, climbing the wall of worry and continued to do so for, from where we are. It continued to do so for probably another 3 months or so before it really finally started to roll over. I think that, Gareth, my view right now is just that there's just so much excess liquidity, and the Fed is doing the best they can to drain it, but it's just taking a long time to drain it.
Yeah, it makes a lot of sense. I think you're right on that. Is that we hear that they've raised interest rates by X percent, which has been huge. I mean, the velocity of the raise, I think, is the shocking part. From going from a quarter basis point to where we are above 5% is just massive. But then you look at how much excess liquidity there was in the system because of COVID. And then you look at, all right, wages have increased substantially, so people have more money. I do think, like you're saying, there are cracks emerging, right? So last Monday when we did the No Shill Zone, we talked about the jobless claims from the previous week being 266,000. And that was the biggest jump since 2021 in people filing for unemployment. And what I was saying is last week to really watch the next number, because sometimes you get these outliers, the data changes this calculation and it changes the numbers. But what we saw last week was 262,000 filing for unemployment, just 4,000 people difference. And to me, that's now saying, okay, it's probably not an outlier. You're beginning to see the effects of people getting laid off and filing for unemployment. So that would be one thing. A couple other things I'm seeing here. U.S. delinquency rates on credit cards are now rising at their fastest pace since 2008, right? So now it's not at the level, right? So the rate of change is rising, right? That's what it's equal to, but you're not at those levels. In fact, I'm going to show my screen here. This is a David Lynn, courtesy of David Lynn. And let me just throw mine in here. So here's his tweet. And I by the way, if you don't follow him, he's awesome at his data. He's a great interviewer and so forth. So definitely look to follow him. But U.S. delinquency rates on credit cards now rising at their fastest pace since 2008, although still nowhere near 2008 levels. So here you have the drive higher is essentially at that same rate, but you're still far below. So what that tells me is that people are still able to do their thing, even though the delinquencies are rising substantially. And then this one's kind of interesting as well, which says credit card debt now at all-time highs. And the reason why this is important in terms of credit card debt is because at all-time highs, if people stop paying their credit cards, it's a bigger deal to banks, right? So, if if you don't pay your credit card and you owe $10 to the bank, okay. But if you own $1,000 and there's a million people that owe 1,000, now it becomes a bigger issue. And being at all-time highs is definitely unsustainable in the long run. The other thing too to just mention as I flip back to charts is that I also read that bankruptcies are now at their highest level since, I believe, 2011. Now, it's not at 2008, 2009 levels, but you're seeing again this shift. So for me, at least as an investor in stocks, in gold, in crypto, it's kind of the yellow light. You're not seeing the red flashing like, holy cow, we're going down with the ship, but you're seeing like, okay, there is a change going on here. And then the bigger question to bring back too is whether or not does inflation go back to 2% or under for the Fed, or do they get themselves in a pickle where we stick at 3% and it makes it very hard for them to bail us out whenever that big downturn comes?
I think there is definitely a risk here of going into I don't know how rapid it would be, but I think the bigger risk is rapid disinflation. Because of just how hawkish the Fed has been for so long. Because again, normally it takes what, a year for rate hikes to really filter through the economy. So there's a chance that they've already gone further than they needed to accomplish getting inflation back down. I think the biggest issue is that they don't want to repeat the same mistakes from the 70s where they flip-flopped every couple of years.
That's exactly right.
That's a worst case scenario, I think, right? Like if they go back to QE too quickly, then we're basically we could go into an environment where the S&P maybe puts in a new high, but only in nominal terms, not in real terms. And then we could also go into an environment where it puts in new lows for the better part of a decade, right? A new high and a new low and a new high and a new low. That's what we did in the 70s. And I think there's a risk to that. Gareth, there's also another chart that I thought was interesting, and the whole labor market. Mm-hmm. And I think this can help us, kind of understand where, why the unemployment rate hasn't really moved despite all the layoffs that we've seen, is that if you look at job openings, right? Like these are total non-farm. Arguably, all the losses that we've seen are just more or less getting us back to trend, right? I mean, This is a prior trend. I think that where's the issue is what happens if we go below the prior trend, like we did back over here in 2020, right? If we go below the prior trend, that's where I think you can get a lot more issues. And the other thing too is that if you look at things like real GDP, right? We did, of course, have 2 consecutive quarters of negative real GDP that were negative back in 2022. There's also gross domestic income, and one of the metrics that some economists follow is the average of GDP and GDI. And if you adjust that for inflation and look at a quarter-over-quarter change, we've actually been putting in some negative prints here. And what's another way to look at this too, I think, is to look at a year-over-year change. And when you look at it like this, you can see that, I mean, I don't know that it has a mishit here. I mean, it seems like every time the year-over-year percentage change of this average goes negative, that's what marks a recession, right? And I mean, right now we're still slightly positive, right? We are still slightly positive. We're just like, we're right on the brink, but the economy hasn't thrown in the towel just yet, right? So we just continue to climb the wall of worry until we have reason not to do so. I'm curious, what is your view here on the S&P 500 in terms of climbing the wall of worry, and do you think it will eventually break to the downside?
Yeah. And this is a great point too, is so just first of all, going back to the Federal Reserve, I think it's important. And I've seen this narrative get lost, but it was around 6 months ago, which is that the Federal Reserve has never really engineered a soft landing. Right. I mean, and again, so I think the market right now is like, oh, they're going to do it this time. It's almost like you're rooting for your team, but they haven't won the championship any past year, but you just willing to believe, because we all want to believe, right? I mean, we want to believe that everything's going to turn out good. That's human nature to want to believe that. So I think a couple things to look at here, going back to my chart here. I apologize. Let me add mine to the stream here. Is that number one, take a look at interest rates. And remember, the Fed basically came out and said, we are going to have to hike more this year. And the market was like, ha, dream on. We don't believe you at all. I mean, literally the market was like, nope, we don't believe you. But if you look at the 10-year yield, this is a very interesting pattern. This is actually a bullish channel of consolidation on the 10-year. And if it breaks above this 3.9 level, you're at least going back to 4.3 and potentially higher. And again, the question then is, how does that affect the overall stock market? The other side of the coin, too, is you can see that we've been holding these are 2 parallel lines. You can connect these lows here, and it's perfectly parallel as well. So there's a lot of support down here, and you have this bullish channel that, again, eventually bullish. When you have a downsloping channel, the thought process is eventually price breaks out to the upside. You don't necessarily know when, but downsloping channels break out to the upside. So if that does happen, that puts me in a position where if we look at the S&P 500, you have to wonder, okay, well, are we going to get to all-time highs? And if we get to all-time highs, is it on this hopium? And again, markets can do that in light volume summer months. We can continue to rally. I mean, it's clear as day that we've been doing that right now with the narratives that have been pushing about this perfect landing. But again, for me, this is a situation where I would not personally feel comfortable buying in at Apple at all-time highs, Microsoft at all-time highs. And by the way, I mean, Microsoft last week, all-time highs, but look, it had a pretty nasty reversal right off that double top right there. One thing to just show on the NASDAQ on the QQQ chart is that there's some major confluences of trend lines right in this area. So I'm a big fan of channels and how channels, for some reason, human nature is to make factors or structure out of chaos. And if you connect the lows here on the NASDAQ going back to 2021, and it connects perfectly through here, 2022, late in 2022, and right here in early 2023, and you drag a parallel up to the all-time highs, you actually get this pivot, and then where we are currently there. Then if you look at this high, which was just before the COVID collapse, the highest point on the market before the COVID collapse, it connects perfectly through that high, these lows here, then this low, we broke below it, and then we retraced to it, and then look at where we are. We're right in that midst right here as well. So at least from me, again, the one thing, the market has a tendency to kind of make you question yourself, make you almost want to flip. It makes most people flip from bullish to bearish or bearish to bullish just before it flips the other way. But the charts are the charts, and there's some major signals to me that we're probably closer to the end of this run in the S&P than not, as well as the NASDAQ.
I feel like the what's the saying? Like the path to a hard landing always goes through thinking we get a soft landing first, right?
Yep.
You go through that process of thinking we get a soft landing anytime you get to a hard landing. There's a couple things. I mean, I am in general agreement with you about where the equity markets are headed. One thing we kind of talked a little bit about last week. If you look at say like the S&P 500 on like longer time frames, like say like we had a bearish period in 2014, and I think there's some seasonality to this too. I think historically pre-election years tend to be good years for the stock market. So like it's fighting that bias, I guess, where like 2019 we climbed the wall of worry. 2015 I think there was some element of climbing the wall of worry. And what I've noticed here, if you look at the chart, is that the S&P found a low in sort of the second half of 2014, and it then kind of retested that low, or maybe even a slightly lower low in early 2016, right? So like maybe a little over a year later, right? Because this was the end of 2014 and the beginning of 2016. Then you have with the S&P, you had another bear market here at the end of 2018. I don't know if you want to call it a bear market; it was a correction at least. And then again, we took out that low, right, about the same time frame later, right, in early 2020, where we put in a new low. And so this is still the same thing, right? Like you put in a low the second half of 2022, we climbed the wall of worry in the pre-election year, but you still have, right, the inverted yield curve that we had back over here. And there are some issues. And there's something else, Gareth, that I thought was kind of interesting. If you look really closely at the S&P, this pattern is actually really similar, right? So like coming out of this low here and this low here, we sort of had our first move higher, second move higher, and then sort of like a brief pullback before the final rally into the capitulation, right? So you're kind of seeing the same thing, right? You got one rally, you got two rallies, you got sort of a very brief pullback. I almost wonder if we're in that final, that final stage of melt up before it actually goes down. But one thing that I mentioned as well is, with the S&P, it in both of those prior cycles, I think it did put in new lows, but only barely. But what's more interesting is the Russell. And I wanted to draw this out because the Russell actually has got put in significantly further lows, right? In this cycle back over here, it was another 10% down. 2018 to 2020, 2018 to 2020 was another 25% down. And it kind of goes back to that idea of like, you know, the higher risk stuff, like the high, and the whether you, no matter what asset class thing you have, right? Whether it's equities, whether it's cryptocurrency, or maybe even you're talking about commodities too, but it's that higher risk stuff that can get hit a lot harder. And if this pattern plays out, you could see a new low on the Russell sometime in early 2024.
Yeah, it's fascinating, man. It really is. And I love the stuff where you know, some people, I saw a comment in there like, you know, these guys are talking about the 70s, how old they are, but I think it's important for people to remember. And by the way, I wasn't born in the 70s. I'm 1980 baby, and I think you're even younger, right?
I'm a 90s kid, yeah.
Yeah, but one thing that Ben and I do understand is that history may not perfectly repeat, but it tends to rhyme, and it rhymes because human nature never changes, right? You go back to ancient Egypt, people were still greedy and they still got fearful. You go back to even, you know, when it was, you know, living in caves, people got greedy and they got fearful, right? And so it makes sense that you can learn a lot from history. So just something to kind of think about there. Now, I want to show you this chart here. So this is the NASDAQ. And I love showing this, right? So the NASDAQ chart, from the highs, it dropped about 38%. And what we can see here is that we've rallied 37.2% back up. Now, a lot of people, the 37% back up makes you feel like you're in a bull market. But what I like to show people is that if you go back historically to these past cycles, right? So let's even go back to the .com bubble, okay? And I'm going to erase that to keep it clean. But we actually had a drop in the .com bubble of about 41% and a 41% rally back up. All right. So now, okay, so that was the .com bubble, and this is the NASDAQ. You know, two factors don't make a trend. But then flip it over here. Let's go back to 1929 and 1930, the Great Depression, right? Well, take a look at the Great Depression. You dropped 50%, which was in there was the 1929 crash. And then you rallied back 52% before, mind you, take a look at this, before price ended up going down. And again, I mean, 85% from that high, right? So again, does it mean that this is 100% the way this cycle is going to play out? No, not at all. But it's important to recognize that even in Bitcoin, you have big rallies in bear markets, big rallies to the upside, and you can still go and be in a bear market. And again, I love showing, especially the 1929, 1930 period, because, you know, needless to say, that was so long ago, but it was the Great Depression. And again, I want to be clear, I'm not calling for a Great Depression here. There's nothing in my charts that are saying it's inevitable that we're going to be in a Great Depression, but it's, again, showcasing how human behavior tends to repeat over and over again.
I think, yeah, I'm not in the depression camp. I'm more in a recession camp. And also too, like that if we don't get a recession, that might actually be worse for the economy. Recessions are actually really good for getting out the excess and making us all more productive. You know, it's not, I think they also create a lot of opportunities for people. They shouldn't be something that we fear. They should be something that investors look forward to. You know, Gareth, you just were looking at those charts. If you flip it over to my screen right here, I'd like to show actually just comparing all the prior bear markets. So this one actually, so the blue line here is the current one, and this is assuming the low's not in, right? I mean, if the low is in, then you argue that the bear market, you know, ended back in October. But if the low is not in, then as a function of time, this bear market has outperformed the prior bear markets going as a function of time, going all the way back to the Great Depression, in fact. But there's some cool things that we can look at here. If we pull up, say I believe it's the one of these. See, if you look at like the 1956 to 1957 bear market, it pulled back like 20% before rallying to a almost a new high, and then still capitulating at the end, right? Yeah. And there's actually a lot of market cycles that do that, where you know you'll get these pretty big rallies that can last for months. This is the .com crash. This is the financial crisis, and then this is the current one, right? You'll get these rallies that can really test your conviction about things, but it doesn't necessarily mean that the lows are in. Look at this one from 1946 to 1949. Like, look at this bear market and how it put in a low. This was coming out of World War II, and I actually think that there are reasons to look at what happened from 1946 to 1949, because I know that we're not really it's not like we're coming out of a world war, but we are coming out of a period of where a lot of money was printed. And so there's also
Yes.
a lot of money printed in a war.
That's an amazing point, is that while it wasn't a world war, what happened in the world war, the US had to spend a ton of money, right? And then
Right.
you look at
Right.
COVID and the effects of how much money had to be spent.
Right. So like if you look at, so the blue line is the current cycle, and then the lighter blue line is coming out of World War II. I mean, there was pretty impressive rallies back then too, and it still eventually put in a new low. 1,100 days into the bear market, right? And for reference, we're currently about halfway. We're about the halfway point compared to that level, right?
Wow.
So I mean, it really does show you how long the business cycle can take to play out sometimes. And by the way, if you think about where this would take us, like if it's only a slightly new low, and it's not a massive new low, that would correspond to I know a target that you've recently talked about as well, and that was that sort of that pre-pandemic high of around 3,400, like 3,300 to 3,400. So if we follow that pattern, then I mean we could still get there. It could take another 6 months. It could take 12 months. I think the thing is no matter what happens tomorrow or next month, it doesn't mean that a year from now or 8 months from now it can't happen. And I think that's the hardest thing is understanding that the business cycle can just take a long time to play out. And until the unemployment rate goes up, I think the Fed's they're gonna stay at it until the unemployment rate goes up. And it's not until the unemployment rate goes up that you'll start to find those final lows.
Yeah, I think that's true, and I think the Fed. It's funny because I think the Fed is feeling their lack of, you know, people's lack of trust in them, right? I think when Jerome Powell came out last Wednesday with the
Mhm.
FOMC statement, and the markets initially dumped out when it was like, oh, we're going to still hike. I think it was about 66% of the board of the Federal Reserve said we're going to do 2 to 3 more hikes in the year. And the markets initially sold off, and then the markets shrugged it off and rallied up the next couple days. And it's really saying, all right, you can tell us you're going to hike. We just don't believe you. We don't believe that the Fed will ever step fully away from the punch bowl, or the money printer. And it's a credibility issue at this point. And then the question is, as the markets go higher, and granted, this isn't for crypto, but there's a wealth effect that adds to inflation, right? So, I always tell people this is they say, well, if the stock market goes up, does it potentially add to inflation? And the concept is that if you look at your 401k and it was 200,000 yesterday, and let's just say it's 400,000 today, and you were kind of thinking about a new car or a new TV, you're much more likely to say, yeah, let me go buy that new car, new TV, because look at my 401k. It's up massively. And
Mhm.
so that's the reason why the Fed is more focused on the stock market and wanting it to come down. But right now they've lost that credibility.
What's your view on the real estate market? Because that's something that, like, I know I don't really talk about a whole lot, and I'm not really sure what your experience in it is. I don't have really any real world experience in the real estate market. I have personal real estate, or I have real estate for personal use, but nothing for like commercial use. I'm curious what your view is on that, because that sort of seems like one of those things that could be like like something that's going to happen in the next few years that will, and going back to what you were talking about, like the wealth effect, right? If housing comes down, I imagine that would affect markets. I'm wondering if we could see something like, where we get out to like 2025 or something, and we're all, a lot of people get bullish again, and then maybe that's what brings us back down in a future cycle. I'm curious what you think.
Yeah, so for me, it's there. And by the way, you talk to some of the biggest people in real estate, and they'll tell you there's two things they'll tell you. Number one, the commercial real estate is absolutely screwed. Banks are carrying they're almost zombie banks at this point because they're carrying so many bad loans. I mean, almost every day, I don't know if you've heard this, but out of California, it's like, okay, this company packed up and stopped paying for their big office building in California, and it's just this exodus because people number one aren't fully going back to work, and number two, there's just this there's this it was this overabundance of real estate that was built for commercial. Now the other side is you can almost find no one that's saying the real estate market's going to come down for retail people, right? The commercial, not the commercial, the residential. And I can't believe that narrative. Like, if you tell me that so number one, housing prices are at all-time highs or just off of all-time highs. So the affordability, if you look at the affordability numbers, it's ridiculous how unaffordable it is to most Americans. Then you say, okay, well, most Americans can't put, if a house is 500,000, most people don't have 20% to put down. So they're going to have to take out a loan for a majority of that. This 30-year loan is now 7% or something. That's a massive undertaking on a basis. Now, remember, just in the debt ceiling stuff, people are going to have to start paying their student loans again. That was one of the things that got taken away, is the non-payment of those student loans. So people are going to have $200 to $300 payments every month. Now you're talking about houses that are already unaffordable and now 7% interest rates. So it's and by the way, we're not even talking about if people start losing their jobs. What happens then? How does affordability change with people losing their jobs if the unemployment rate just goes to 5%, let's say? So I think, for me, and I'll show you, I'll show you this chart here. This is the KBH chart, KB Homes, and it has been on an amazing move. And I have shorted this, right? I am short right now. Part of it's chart basis, right? You got this beautiful little kind of double top up here, but the other side of it is that I'm just not a believer in the narrative that so many big names are spinning that home prices are just going to stay where they are or continue to go higher. Now, the reason why they're saying that is because there's so much demand, but a lot of that demand, you could argue, is coming from Airbnbs, right? There's so many people bought multiple homes to use as Airbnbs. And if the economy does weaken, how many of those, number one, do they stop paying their loans on them? Because the thought process was, okay, I have an Airbnb. As long as I can rent it out 2 times a month, I can pay that loan with that profit that I'm making. Well, let's just say the economy does go south, which is what the Fed's trying to do, and you can't pay that anymore. Are you really going to keep up 3 payments, on homes, your own home and 2 others that were Airbnbs? No. And then so you get those to come on the market, and I think you could see a massive inflow of new homes on the market if the economy does weaken.
But that process, I mean, I guess the real estate market, it's a very slow moving asset class, right? So even if it does start moving in that direction, I mean, it could still be a multi-year process, right?
Yes, and it would be. I mean, again, what's interesting is the 2007. I mean, if things started to unravel in 2007, that was actually very, very quick. But we didn't really see, like, at least in Florida where I am, the recovery didn't really start until 2014, 2013 to 2014. So that was one of the quicker scenarios because it was a financial crisis where you had these banks collapsing and people really just started running away. I do think that this one will be a longer scenario where it could be as late as 2025 to 2026 before we see significant discounts. I think you're already seeing like the home I own, it's gone down a little bit in value on Zillow, but it's nothing significant at this point yet.
Okay, yeah, I mean, some of the places that I've looked at recently haven't really moved a whole lot. There's just no inventory, I think, is the issue. But I guess the problem is well, if the economy does turn, then people might be forced to sell. And
I think that's kind of where I am on it, where if the economy turns and you don't see people, booking Airbnbs nonstop, does that then start a new process of dumping properties on the open market to try to offload them?
Well, it's kind of like, I mean, I guess it's kind of like any market, right? I mean, capitulations happen when people are forced to sell, right?
Yes.
And they're leveraged beyond what they can imagine, and they're forced to capitulate. It's not that they want to. It's not that they think the asset class will never recover. It's just they have to sell.
Yeah. And here in Florida, I mean, I could just speak like in my neighborhood. My neighborhood's made up of 11 homes. There's just an 11 home community. There's 3 homes that have been up for sale now for months, and they've had to drop the prices and still no one's bought. Now, these homes are multi-million-dollar homes, so it's not like it's John Q. Publix that'll be able to afford them, but it does speak to price cuts starting. What I would refer to it as you're in the first inning of a 9-inning baseball game, right? It's the very preliminary first pitch kind of stuff coming out right now.
We've talked about the stock market, we talked about crypto, we talked about some commodities, we talked about real estate. Maybe the last thing I want to, maybe we could just briefly touch on, then we should maybe wrap it up. I'm curious what your view is on some of these bonds, like things like TLT. I know a lot of times people use these things as downside protection, and I'm tempted to do so, and my plan has been to get some, but I'm also I've also been very cautious because there's part of me that thinks, and the reason I'm thinking about this is because you were talking about the 10-year yield earlier, and if long-term treasuries, like if the 10-year and the 30-year are going up, then that means TLT is going down. And so
Right.
I'm curious, but I guess the counterpoint is that they can provide a hedge in case the economy just completely goes to crap in the short term and the Fed's forced to cut rates. So like from a technical perspective, like what are you looking at on TLT? Because I can make the case either way, I think.
Yeah, I know, and that's where I am too. I'm in this position where I'm like, okay, well, if the economy's going to weaken, how are rates going to go up? But then when we looked at the 10-year chart, the 10-year did look like it was potentially getting ready to break out.
Right.
Looking at the TLT here, you had this long-term downtrend, and then you kind of have gotten into this very tight range. Right. And
Right.
so for me, it's more, at least on the TLT, the way I look at it is like, okay, you have a range here and it stayed within this range. Whichever way it breaks, that's probably just like the Bitcoin dominance chart, right? When it breaks, at some point you probably get a bigger move out of it. So for me, it's kind of watching this low end, this 99.5 to 100 level. If we break below that, then honestly, you're probably testing these lows down here. If we come up to the highs and break out, then this is a, and by the way, this is kind of an inverse. So the TLT is like an inverse, right?
Right.
So if rates go up, this goes down. And
Right.
if rates go down, this goes up, just so people that are watching understand the metrics of it. But yeah, I mean, right now, I mean, the one thing you can say is that rates have been held in a pretty tight range for actually a long time.
Yeah, well, I was thinking too, because like, I mean, the Fed doesn't always control the long end of the curve anyways. I mean, that can also be more so anticipating what's going to happen. You know, I mean, if inflation expectations are changing long term, of course, that will affect uh, like some of these long-term rates. But that was something that I've been thinking about getting a position in. I haven't, you know, I've been kind of cautious because I'm like, well, I mean, the Fed's gone, they've raised rates so much, but I mean, at this point, while it seems like things are heading in the wrong direction, the economy is kind of like hanging on by a thread, you know?
Yeah.
Um,
What
so
what are your thoughts about the inversion of the yield curve before we wrap things up? I'm just curious because we've seen a pretty significant inversion.
yeah, so let me pull that up because I have so you're talking about the inverted yield curve, but one, I mean, I can briefly pull up the yield curve. Can you see my screen here?
Yep.
Yeah, so I mean, look, we have an inverted yield curve. Normally, when you go back in time, you can see like we have inverted yield curves just before recessions, right? I mean, this is what the yield curve looked like back in 2007, early 2007, by the way, and things didn't really get bad in the economy until later on in 2008, 2009. Same thing occurred, of course, before the dot-com crash. We got into an inverted yield curve as well, and we know what happened after that. And that's where we are again today. I think the way I like to view this though is to look at the spreads. And so like this is the spread on the 3-month and the 10-year. And as you said, Gareth, I mean, we haven't really seen this before, at least not since like the 1980s, the 1970s, also during a period of high inflation. One of the things that I think people will often point to is like, oh, we have an inverted yield curve. That means we have a recession. But in reality, you know, if you were to only tell me, like, if you were to say, hey, Ben, in 50 years, we're gonna go inverted. Do you think we're in a recession or not? I would say, well, we're probably not in a recession once it inverts, but upon the uninversion, we could go into a recession, right? It's normally upon the uninversion of the yield curve where you go into a recession. As you can see over here in the late 1980s, we got an inverted yield curve at uninverted recession, right? And then in the 2000s, inverted yield curve, uninversion, recession, and then again in 2006, 2007, right? Inverted yield curve, uninversion, recession. Now, I do think, and even in 2019, 2020, I do think there is a chance that we could go into a recession before the yield curve uninverts, but I don't know that that would be my base case. The only reason I say that there's a chance is because even over here in the 1980s, we had some periods where it was slightly inverted and we were in a recession. And I think the case to be made for that is during periods of high inflation, the Fed is forced to remain hawkish longer than they otherwise would have. Therefore, you could go into a recession before we go back to healthier rates.
Yeah, exactly. Now, is the inversion historically that we're seeing now? And I don't know if you know this, but is this like, are there past periods in history where it's been this or greater an inversion?
So, I mean, on my chart, I'm only going back here to like 1981, and you can see where we are right now. It is
Yeah.
more, it has been more inverted than that. This is the spread on the 3-month and the 10-year. I can switch this to the 2-year and the 10-year. And if you look at the 2-year and the 10-year inversion, we've actually have been more inverted in the
Wow.
past. If you look at the 1980s, you can see that it was even more inverted than it is right now. Also, note though, that in the 1980s, we actually got 2 recessions more or less back to back. I think that was when Volcker finally knew what needed to be done. after they spent 10 years, in Burns, and they spent basically 10 years doing what they wanted, doing what they felt for or pressured to do rather than what they needed to do. Then in the 1980s, they finally were like, all right, we just need to do this until inflation comes back down. And it came on the back of 2 recessions. And you can see here that during that period, we actually had a recession before we had the uninversion of the 2-year and the 10-year yields. And in both cases. So I think there is a case to be made that we could see a recession before the uninversion process starts, mainly because we're comparing it to prior periods of high inflation. But something that I think we always need to remember, especially in the future as well, is that when it inverts, it's not normally a sign of a recession, right? It's a sign that a recession might come within the next year or 2.
Yep. Yeah, for sure. For sure. Wow. Amazing information, guys. And I see the comments, you guys loving the information. And I think that's what we're here for, is to kind of get away from the crap that people see in social media and that get sway. And listen, we're just presenting different things and kind of our thoughts, and then you guys can really take the information and go with it. And I think the first thing I'll say is that, while I don't project out new all-time highs on the stock market, it doesn't mean that it won't happen. I say that Bitcoin might make a low at 12,000 or break 15,700. That's my perspective. Doesn't mean it's going to happen. So the key is all we can do is look at the data and use the data to make informed decisions. And I think that's what the No Shill Zone is all about. So we'll wrap it up there. Ben, do you want to leave any? Do you want to talk about your website? Anything, give people a little heads up that maybe don't know you, that know me more?
Yeah, I mean, we have a website with all these charts, so you can get access into the cryptoverse.com. And I know Gareth, we provide very different perspectives, because I think I'm more passive, but Gareth is a lot more active in investing than I am. So I think there's a lot of people that might also on my channel would like to hear what you're doing over there on your end.
Yeah, absolutely. And again, I basically am a swing trader. So I'm going long, I'm going short in stocks, commodities, and in crypto. Although I will say that the crypto service is there's not a lot of trades right now. It's all crypto follows Bitcoin generally, although we've seen that divergence with the altcoins. So again, it's being patient, it's being disciplined, and letting the charts dictate and the data dictate the moves. So yeah, it's wonderful. Thank you guys for tuning in. I mean, amazing how many people watching this live. That really warms our hearts. And we will be back next Monday to do it again for you guys. So spread the word. If you guys could follow both of us on Twitter, on YouTube, share this stream to your friends if you think they would find it useful. I'd love us to get to 5,000 live viewers next week from the 3,800 that we had today. All right. You guys have a wonderful one. Thank you all. Have a great one. Take care, Ben.